Every 4 years, it's the same story. Political headlines dominate the news and investors start to worry. But what does history actually tell us about how midterm elections affect your portfolio? Midterm election years have historically been marked by both heightened risks and eventual opportunities. While political cycles aren't the only driver, the combination of policy uncertainty and fiscal debates often weighs heavily on investor sentiment. Let's talk about the risk. Since 1930, the S&P 500 has experienced an average peak-to-trough decline of nearly 20% during midterm years. That's a significant dip compared to the average 14% correction in any given year. Three things drive this increased volatility: uncertainty around policy, challenging economic cross-currents like inflation, and investor psychology shifting to a more defensive position. The result is that these periods have often been among the more difficult stretches for investors, with volatility spikes and elevated downside risks compared to other phases of the political cycle. But here's where the story turns. Once the votes are counted and the uncertainty recedes, markets have historically offered significant opportunities. In the 12 months following a midterm election, the S&P 500 has delivered above-average returns. On average, 3 months after, returns average about 6%, 6 months after over 10%, and a full year later, returns climb to roughly 13% on average, with over 90% of years showing gains. To put that in perspective, these results far exceed the average returns for all other periods. Historically, the volatility of a midterm year has consistently set the stage for strong forward performance once the political uncertainty clears. This suggests that for those who can remain disciplined and rational, substantial recovery potential after the turbulence may exist, rewarding investors who stay the course or who heed Warren Buffett's famous words: "Be greedy when others are fearful, and put capital to work after the election." So, what's the key takeaway? First, understand that midterm years are riskier and that larger than average corrections are common. But second, and most importantly, the recovery potential is significant. While no historical pattern guarantees future performance, the evidence is clear. Staying patient, diversified, and disciplined remains the most reliable strategy to navigate these cycles. To dive deeper into this data and learn how you can prepare your portfolio, engage with LRG Wealth Advisors today.